February wholesale prices, PPI, increased sharply at 3.4% year-on-year. This is even aside from rising energy cost. Policymakers attributed this increase to tariffs. And so far, none of the inflation data was linked to the US-Iran war. Oil prices have been trading at high 90s or even higher than 100, fluctuating at that level, and then the stock market dropped because of the potential of higher inflation levels. Last week, Fed kept the Fed fund rate at the same level, between the range of 3.5% to 3.75%. The Iran war obviously has a lot of implication on inflation. A lot of the goods and services that we consume, energy prices are a major input. The simplest one is supply chain, freight, through air or sea. When oil prices are high, those functions will also be more costly or even delayed. The Fed will wait and see for what will happen to oil prices and the effect on inflation. Before the Iran conflict, markets are quite optimistic in the number of interest rate cuts. But now, because of the energy shock, rising oil prices, and the recent firm inflation readings, expectations of interest rate cuts have been pushed down to at most one cut this year. And looking at the dot plot chart at the right, very likely by the end of this year, the median interest rate figure will be 3.4%. Looking at the whole thing, it's still a lower number than where we started off. Trump issued a 60-day waiver on Jones Act shipping law to stabilize the oil market and allow vital resources like oil, gas, fertilizer, and coal to flow freely to U.S. Jones Act started in 1920. It requires transport of goods between U.S. ports must be conducted by U.S. vessels. This law is U.S. efforts to grow its domestic shipping industry after World War I, but it's criticized as protectionism and impeding domestic trade. Currently, there are fewer than 100 Jones Act-compliant vessels. That's why with this Jones Act, it further affects the shipments to U.S. ports. Waiving the law frees up international tankers to carry fuel between U.S. ports, basically making it easier. Next, the latest news on the US-Iran war. Trump said that he ordered U.S. military to postpone strikes on Iran's power plants and energy infrastructure for 5 days. But Iran said talks have not taken place at all. And about the market, it picked up a little after Trump's comments on the postponed strikes. And looking at which countries have been moving vessels through the Strait of Hormuz will somewhat create some form optimistic effect which could spill over. China vessels have been moving through the Strait of Hormuz, India as well, Greece too, and Turkey. On to EU. Many government bonds have been sold off because of new inflation fears. The Iran conflict is pushing energy prices very high, and many European countries are very sensitive to energy prices. Despite the efforts to diversify and improve these problems, they're still a net importer of oil and energy. The previous highest impact was in 2022 during the Russia-Ukraine war. They also had the same problem because of high oil prices, which pushed energy prices up, and their inflation levels went really high. UK, at one point in time, had double digits inflation. The highest was 11.1% in October 2022. So that's why markets are not confident in European countries now. UK suffered the most, with its sovereign bonds sold off the most. And whenever the price drops, that means when you calculate it from the lower price perspective, the yield went up higher. It's close to 5% now. The big European countries faced the same problem. France, Germany, and Italy's sovereign bonds were also being sold off, but not as intense as UK. So again, for some background, the reason is energy prices have been going higher. Energy is an important input for many goods and services. When energy prices are very high, it'll naturally filter into overall costs of goods and services. The Bank of England is talking about potential rate hikes now. Maneuvering interest rate is one way to tame demand, pushing it lower to match supply, which typically keeps inflation level in check. By learning from their history back in 2022, UK want to keep inflation low. For asset allocation perspective, investors might, for a tactical approach, go overweight in UK government bonds with shorter maturity. The bonds' current lower prices look appealing because when you enter at a lower price and calculate it, your yield will be higher. The shorter term also carries lesser duration risk, both in terms of maturity risk and sensitivity to the market. The European Central Bank will still be more cautious in rate hikes because their growth isn't that fantastic to begin with. They're stuck in the middle of growth versus inflation. Interest rate typically affects growth and inflation levels. China mentioned that they have enough energy resources. The foundation is good. The stockpile is high at 1.2 billion barrels that can help them with 1/4 of the year, 3 to 4 months. And Iran has been sending them oil. For Japan, exports increased 4.2%, a natural slowdown coming off January's 16.8% high. Semiconductor is the one supporting export growth. Exports to the bigger countries slowed. Export to China and US both dropped. But exports to places like Hong Kong and Europe increased. In Japan, exports of goods and services remain a significant part of the economy. They contribute to about 1/5 of GDP. With exports being stable, it's a relatively optimistic sign. Inflation dropped again. They want it to be near 2%, but now it's been dropping. January was 1.5%. February came in at 1.3%. Inflation level dropped because of food prices stabilizing, and the government rolled out subsidies in energy prices. Utility prices, which covers fuel, light, and water, dropped. Electricity and gas prices also dropped. Early this month, the government introduced subsidies to curb gasoline prices because of the US-Iran war. They also removed gas tax surcharge. The government also pledged to suspend the 8% food tax for 2 years. For Japan, high food prices have been a problem for them. It's been a central subject, especially during the elections. Now, inflation in rice prices eased. In February, it's 17.1%. Back in January, it's almost 28%. And lastly, for growth, the full year last year was 1.3%. And when you look at Q4 2025 to Q4 2024, it only grew 0.1%.